Welcome to the Level 1 Economics Summary video series. This video is a summary of the reading on international trade and capital flows. International trade. Understand the distinction between GDP and GNP. Gross domestic product refers to all goods and services produced within a country's geographical boundaries. Gross national product refers to all goods and services produced by a country's citizens. This does not include foreign citizen production within the country, but it includes products of a country's citizens all across the globe. Is international trade good or bad? Generally, the argument is that it's good because with international trade, we have lower cost to consumers of imports due to more efficient allocation of scarce resources, higher employment, wages and profits in export industries, and economies of scale. However, workers may be displaced and profits may be lost in industries competing with imported goods. Net balance is that most economists believe that the benefits outweigh the costs. You need to understand the distinction between the absolute advantage theory and the comparative advantage. Absolute advantage refers to an absolute cost advantage in the production of a good when compared to another country. Comparative advantage refers to a comparative cost advantage, so a lower opportunity cost in terms of other goods that could be produced instead for the production of a good when compared to another country. We'll now look at models of trade, and this is just something you need to remember. We have the Ricardian model of trade and the Heckscher-Ohlin model of trade. With the Ricardian model of trade, one factor of production exists. So that one factor of production is labor. And according to the Ricardian model, the differences in labor productivity is the key source of comparative advantage. With the Heckscher-Ohlin model of trade, both capital and labor are variable. Goods produced with varying combinations of labor and capital. So goods are produced with varying combinations of labor and capital. Differences in the relative endowments of these factors are the sources of comparative advantage. So if you have a labor intensive industry, then a country like India will have a comparative advantage in those industries. Industries that are capital intensive will do well in countries like Germany, where there is high capital per unit of labor. So that's the point made here. Countries with relatively high labor will focus on labor intensive industries. Technology in each industry is the same across countries but varies between industries. This allows for income redistribution through trade. Trade and capital restrictions. These are the various sorts of restrictions that you need to be aware of on the trade side. So you can have tariffs. These are taxes on imported goods collected by the government. Quotas, these are limits on the absolute amount of imports allowed over some period, typically a year. Export subsidies, these are government payments to firms that export goods which artificially reduce cost of production. And then voluntary export restraints. These are agreements by exporting countries to voluntarily restrict the amount of a good that can be exported, often in the hope of avoiding tariffs or quotas imposed by trading partners. Then we come to capital restrictions. These are outright prohibitions of investments in domestic country by foreigners. So these are the different kinds of capital restrictions. So one category is outright prohibition of investment in domestic country by foreigners. Another restriction is prohibition of or tax on income from foreign investments by domestic citizens. You can have a prohibition of foreign investment in certain domestic industries or restriction on repatriation of earnings of foreign entities operating in a country. This slide is important. It talks about the effects of alternative trade policies and it has been taken straight from the curriculum. I'll just summarize this to help you remember. We are talking here about tariffs, import quotas, export subsidy, and voluntary export restraints. Notice that all these items have a positive impact on producer surplus. So producer surplus invariably goes up. All these items have a negative impact on consumer surplus. So by and large, when there are restrictions, the consumer suffers. What about government revenue? The impact on government revenue is mixed. So keep in mind that government revenue always goes up with tariff. With import quota, the impact is mixed. It depends on whether the quota rents are captured by the importing country through sales of licenses or by exporters. With export subsidy, since this is a subsidy, the government revenue obviously falls. And with voluntary export restraints, there is no change to the government revenue. In terms of national welfare, by and large, that decreases. The only case where that might not happen is with an import quota and a tariff where the country is considered a large country. A large country is one that has a major impact on that particular industry. For example, in the auto industry, the United States might be considered a large country. Whenever we have these trade-related restrictions, price generally increases across all categories. Domestic consumption generally decreases across all categories. Domestic production increases across all categories. Trade agreements. These are regional trade agreements. The most basic type of an agreement is a free trade area or FTA. Here, all barriers to imports and exports of goods and services among member countries are removed. So NAFTA is an example. So between America, United States and Mexico, for example, goods and services can easily flow, but people cannot flow without restrictions. So free trade area is your most basic form. And at the other end, the highest level of integration is a monetary union. In a monetary union, everything is the same institution, same currency, people can move, products and services can move. So I'm just going to the beginning and end to help you remember. Then you have three in the middle. After free trade agreement, you have a customs union, where we say that in addition to free movement of goods and services, all member countries adopt a common set of trade restrictions with non-members. So the next level of NAFTA would be that the United States and Mexico and Canada say to Europe that, look, all three of us have the same import-export restrictions with non-member countries. So that is CU. Then comes CM, or common market, where we say that now in addition, movement of labor and capital goods among member countries are removed. And this probably will not happen with NAFTA, otherwise half of Mexico will end up in the United States. But that is the common market. And then economic union, in addition, member countries establish common institutions and economic policy. And the way I can encourage you to remember this is, remember the boundaries, which is the free trade agreement and the monetary union. All right, CU for customs union, CM for common market, and EU for economic union. Balance of payments. You need to know what makes up the current account, capital account, and financial account. At a high level, current account covers your basic trade, merchandise and services, income receipt, remittances, etc. So income receipt, this is foreign income from dividends and interest earned on investments, and unilateral transfers of assets, which is remittances. Then the current account, let's say the current account is in a deficit, that is financed by the capital account and financial account. So capital account and financial account refer to the flow of money. Capital account covers capital transfers, and it covers sales and purchases of non-financial assets. And then financial account covers government-owned assets abroad and foreign-owned assets in the domestic country. Influences on the balance of payments position. Keep in mind that the net exports can be shown as S minus I, which is savings minus investments, minus the government deficit, which is G minus T. The final slide here, international organizations. So the major organizations that you need to be aware of are the IMF, World Bank, and
World Trade Organization. The IMF, has two major points that you need to know. This takes care of international monetary cooperation and exchange rate stability, assists in setting up international payment systems, makes resources available to member countries with balance of payment problems. The World Bank makes low interest loans, interest-free credits, and grants to developing countries for many specific purposes, provides resources and knowledge, and helps form private-public partnerships with the overall aim of fighting poverty. And then you have the World Trade Organization. This ensures that trade flows freely and works smoothly. The main focus is to institute, interpret, and enforce a number of multilateral trade agreements which detail global trade policies for a large majority of the world's trading nations.
If you found this lecture helpful, then I'll be very grateful if you can do three things for me. Number one, like this video. Number two, like my Facebook page. And number three, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.